your coffee, make sure you guys head back in, okay? I know it has been a long first half, but it was very, very, very insightful and impactful. And to lead our next battlefield panel, the new roll-up play evolution of e-commerce aggregators in Southeast Asia, I'd like to invite our moderator, Lars Wardish, Principal Consultant and Managing Director of Precious Communications, and joining the stage for this session is Dennis Nguyen, Founder, Chairman, and CEO of Society Pass, Kiran Tana, Founder and CEO of Una Brands, and JJ Chai, Co-founder and CEO of Rainforest Life. Put your hands together.
Thank you very much. Good morning, everybody. So day 2 here, we have a fantastic topic, e-commerce aggregators. With us, and so I'm Lars, originally from Germany, but in Asia for over 20 years. But that doesn't matter because we're talking about Southeast Asia e-commerce aggregators. And how that can be differently interpreted, we'll see from our panelists. So let's start with JJ, quick introduction and what's the business model? What is e-commerce aggregator from your point of view at Rainforest Life?
So at Rainforest, we buy and build e-commerce brands. We do these brands that sell to the US predominantly. We do predominantly marketplace brands on Amazon.
Kiran, you want to continue?
Hi everyone, I'm Kiran. I'm CEO of Una Brands and founder and CEO of Una Brands. Similar business model to JJ, but we focus purely on APAC brands. What we do, in a nutshell, we acquire great e-commerce brands. We acquire them 100% and then help to grow them into global, well-loved, enduring household names. That's the mission statement. In short, we are building the digital version of Unilever or P&G. So acquisition-focused consumer play.
And Dennis Nguyen from Society Pass. How is e-commerce aggregation different from your point of view? How's your different business model working?
Yeah, hi, my name is Dennis Nguyen. I'm the founder, chairman, CEO of Society Pass Incorporated. We are an acquisitions-focused e-commerce holding company listed on NASDAQ. In fact, completed our IPO on NASDAQ November 2021. Since our IPO, of course, we have acquired 8 companies, principally in 6 verticals: loyalty, food and beverage, lifestyle, travel, telecoms, and of course, digital advertising. Currently operate in 5 Asian companies: Vietnam, Indonesia, Philippines, Singapore, and of course, Thailand. And as a result, with our e-commerce acquisition strategy, we actually acquire companies versus the 2 gentlemen here on the stage acquiring brands. And so very excited about where 2022 is ending. Much more excited about where 2023 is coming up.
Thank you. So let's start with JJ. So growing businesses, acquiring companies is considered the biggest challenge right now is how do we get the capital? It's very capital intense. Is that the biggest challenge for you this part of the year or the cycle? Or what's the biggest challenge to bring your company to the next level, the next level, the next level? Is it the financing or what is it?
So for us, obviously, starting financing is a big part of it. It is a capital-intensive business. You need both equity and debt to acquire. We've been fortunate enough, to be able to raise a sizable amount of capital to do this. Interesting enough, actually, while globally there's been a lot of capital raised in Asia, actually, compared to the size of the market, there's actually small amounts. People like Kiran, myself, and only a few other aggregators out there. So there's a lot of white space out there for this. But actually, the biggest challenge is really around being able to operate the brands really well, right? So think about the sort of analogy around Unilever or P&G. These house of brands or holding companies have been great at winning the physical shelf, right? So they get into your sort of Jaya Grocer or NTUC and win that shelf. Like we have to be great at winning the digital shelf, right? Which is like, how do we get there in the Amazon space, online, wherever you spend online and be on that shelf. So that's the capabilities we are trying to build to be have an unfair advantage in that space.
So follow-up question quickly like that. So you're first and foremost a marketing and brand company?
Well, you start from the end result, which is what does it take to win the digital shelf, right? Like that has everything to do with tech and digital and how do you sort of manage operations as well. So they all still come in together, but the end goal is really winning the digital shelf.
Thank you. Let's go to Kieran. Why do you think it's a great time for that aggregator model right now in Southeast Asia? I mean, it has been proven in the US, in Europe, billion-dollar companies there. Is it just we try the same here? Is it completely different? Is it greater opportunities? How's it different at this time and place?
So you mentioned this correctly, which is the aggregator model, or actually e-commerce brands being able to sell the brand to a buyer has been around in the West for at least 5 to 10 years now. Since Amazon has third-party sellers, this business model has existed. It's only in the last few years that Thrasio, Perch, or some of the European players have been able to professionalize this buying in a very large way. We see absolutely not, we see many great brands in the APAC region, but very few acquirers of these brands, and this practically didn't exist until a couple of years back when us and some other players came into this region. And so we do see that there is a lot of great brands that we can still acquire. Many of these brands have had bumper years in 2020 and 2021 on the back of COVID-driven e-commerce. They've done very well, but now it's going to be a challenge for many of them to grow beyond where they are without actually having those capabilities to expand beyond their home market in many cases, or bring a lot of new products into the picture, or expand to the, let's say, to the Western markets as well, or Amazon or Walmart. So I think those capabilities we bring to the table, and that's why we see an even bigger opportunity despite e-commerce slumping this year in the West. We see in APAC even bigger opportunity for brands to partner with someone like us to take their brand to the next level and share in the upside with us.
Okay, so just to get that out of the way, what would be the perfect company that should approach you after the session?
The perfect company for us is someone doing between 1 to 20 million revenue, so we have a wide mandate. Doing profitable company, growing top line in a decent, not great pace, but at least a decent pace. Facing some challenges in terms of growing beyond what they are doing currently, and willing to work with someone like us to help to take the brand to the next level. At the same time, also getting some liquidity in terms of a partial exit on the table.
JJ, you have your sales pitch in a moment, but let's move to Dennis first. So those two gentlemen's business models are around buying profitable brands with a lot of debt financing. You're a NASDAQ listed company, so I've been told you have to be a little bit more careful also on your statements. But how's that? What are you looking for? What would be the ideal e-commerce business that would fit into what you want to achieve?
So, we operate in 6 verticals, as I mentioned earlier. And in those 6 verticals, we are very much consumer e-commerce focused. So typical company would be somewhere between, I don't know, as he said, 1 to 20 million in sales. Could be less, could be more. Again, we have wide latitude in what we have told the market when we completed our initial public offering. Having said that, I'm focused on 3 metrics: revenues, users, and of course merchants. Since we've started, we've now onboarded over 3.3 million registered consumers and over 200,000 registered merchants and brands. And so with that, as we grow the ecosystem, depending on the vertical that we're in, whether it be travel, lifestyle, telecoms, digital advertising, so on and so forth, what we want to do is we're going to be introducing our loyalty points onto that ecosystem. And as with the loyalties, we call it Society Points in Society Pass, consumers and merchants will be then able to earn and redeem these loyalty points to then buy and sell tickets, hotel vouchers, airplane tickets, goods, lifestyle products, and so on and so forth. And so that's what we're building in the next digital ecosystem here in Southeast Asia.
Thank you. Let's directly dive into one of the more hot topics. It's funding has dried up rapidly. How does it affect, and I go to all of the gentlemen, how does it affect your business model? Is it harder to find the right place? Is it better to buy the right assets now? And how does it affect the search for eventual profitability, if that's the end game?
The last question is a much more difficult question to answer, by the way. But the first series of questions, look, 2022 has been difficult in the markets in both the public and private markets. I note NASDAQ, depending on what day you're looking at, over the last 3-4 months is down 20 to 45%. We're on a downturn again, despite being up sometime in August. That has effectively affected the private markets. And so you look at the venture funding globally in the second quarter, $108 billion were actually funded into over 7,000 startups, of which 50% went to the US companies, 21% went to European companies, and the rest effectively went to Asian companies. Of those Asian companies, 28 billion were funded, 18 billion in later stage, 10 billion in early stage. And you look at 10 billion, you think that's a lot. I note that that is 40% decline from the fourth quarter of 2021. So what does that mean? That means startups are increasingly much more nervous in seeking and getting venture funding, which means valuations have precipitously dropped. And we've seen that in our business over the last, in the second and third quarter. Deals that were originally priced at $1 now are priced at 25, 30, 50 cents. And so obviously that has helped us in making our acquisitions. And we've made 8 acquisitions in the last 2 quarters. And so we're looking at the environment, and it's been a net very positive for Society Pass as we make these acquisitions going forward.
Thank you. JJ, also with the perspective of where the funding and private markets landscape is, 2 questions. One is with interest rates going up, and you're very strong on debt financing because you're buying profitable companies. Have we already hit a target where debt financing might not be the way forward anymore? Second, similar question that I posed to Dennis, with the markets under pressure, is it easier or harder to buy? Because everybody's coming off that e-commerce boom, but nobody knows, is it free fall or when are we bottoming out?
Cool, yeah, maybe I'll address the second question first, really around, the sort of funding situation. So we've been lucky enough to be able to raise about over 100 million so far in funding, both in debt and equity. So that puts us in a good position to sort of acquire at scale now. I think if you're in the market now looking for funds and so on, it's a difficult situation. What this has done for the entire ecosystem is that because there's actually overall less funds into the aggregation space, there's actually less competitiveness for deals. So valuations for these targets have gone down. It's actually easier to find these deals. We also see that individual operators are actually more willing to sell now on the back of e-commerce slowdown. And it's all like, look, we need help. We need a different kind of ecosystem to actually build our brand. So that's been a plus side for us, especially those of us who have been able to sort of raise the funds ahead of so-called the winter. Right? On the debt side of things, what's interesting is that when you start off, we're a 20-month-old company. When you start off at that level of our organization, debt starts off at a very high price. Some of the sort of venture debt folks are in the crowd, in the mid-teens kind of range, right? Fortunately, even with base rates going up, you start at such a high point that as your business grows and you get towards profitability, the cost of debt actually goes down, and we still see a lot of room for that at this point in time.
Thank you. So, Kieran, for your company, sorry, I have to jump back one time for JJ because I promised him. What would be the ideal company for you to buy? Also up to 20 million revenue? Just that everybody had their spiel here.
If you want to set up a brand that eventually wants to sell to one of us or Rainforest, for Rainforest, go do something in the moms and kids space, do something in the consumable space, selling to the US market, build a $5-10 million business, and we're happy to take a look. But don't do it to sell to us, do it for yourself, make a great brand, right? Exiting to us is just one option, right? We'd love for you to go make a great D2C brand yourself.
Thank you for that encouraging kind of statement. Kieran, so we touched on the point that the e-commerce aggregator model has started somewhere else. We're here. Where do you see the maturity of the market, and how does it affect how you approach the situation?
Sure. So if you look at the e-commerce space in general and D2C in particular, the West has been far ahead of APAC, let's say even 5 years back. And brands are only now starting to come up. You see now many brands coming up in the half to 1 million range, quite a few brands coming up in the less than 5 million range, and a few brands have been able to break out of the 5 to 10 million barrier, right? So we do see that the market is starting to see those early successes and starting to mature. The ecosystem around these brands is also starting to develop. And the expertise, which if you want to find like D2C expertise in this region, it's actually very difficult. But that expertise is slowly getting built in this region. So we do see that maturity is much lower, but on the rise. And also because of this low maturity, as someone like, let's say someone from this room wants to start a brand, it is very easy to start something off and get to like, let's say 5,000 revenue a month or 10,000 revenue a month. But to scale to 1 million plus revenue or a 5 million plus revenue, it becomes a bit more difficult. And that's where someone like us comes into the picture, where we are able to work with brands who have been able to reach that first hurdle, but don't know how to go to level 2 and level 3. We have that platform, we have the expansion capabilities, we have the product capabilities, and the tech platform to be able to take the brand to a different level. And so that's where we want to position ourselves as to grow brands from good brands to great brands.
We're talking about the brands, but brands are started, built, loved by people. So you acquire the brand, where does it leave the original founder?
Sure. So when we first of all, I think we use a lot of technology to identify great brands which fit our portfolio in the revenue range or profitability range. Then we try to build a personal connection with the founder as well. So we have teams on the ground in all the countries that we operate who will meet up with the founder, explain what we do, understand the challenges that they are facing in their own businesses, understand what they have done well or where they need help, and position our offering as a chance to be able to get some reward for the great brand that they've built in terms of immediate cash payout, but also share in the upside as the brand grows with us. Post that, then we are able to identify various levers to work with the brand to grow them into new geographies or through new products. And that's how we try to position ourselves as well.
Thank you. Dennis, for the companies that you are aggregating, how much is it the brand, the technology, the customers that they have, or the founding team?
I think it's a combination of all three, actually. We were talking earlier about, is it investment, is it marketing, is it technology? My view is it's not mutually exclusive, it's all of the above. And so when we acquire our companies, I'll give you an example. We just acquired an online travel agent called Nusatrip out of Indonesia. It's one of the leading travel websites here in Southeast Asia. They have their own specialized technology where they're able to identify much quicker, attractively priced tickets from airlines. And so they do that through a different algorithm that go through. And so in that particular case, of course, we acquired it for the technology, for the software. However, having said that, Nusatrip is one of the 3 online travel agents in Indonesia. And so Indonesia being a 275 million population market, we definitely believe that being able to acquire something like that, we're able to grow very quickly in Indonesia. And then, of course, then take that out to the rest of Southeast Asia. And so in my view, it's a combination of all 3. Now, having said that, when we acquire our companies, the entrepreneurs, by and large, stay with us. And they stay with us because we incent them with KPIs to actually generate a lot more value for themselves as well as the company. And so of the 8 acquisitions that we've made, the entrepreneurs have all stayed with us. And you're looking at staying with us 2, 3, 4, 5 years as we build out the individual subsidiaries in our ecosystem. And then eventually we spin them out into separate publicly listed companies.
Okay, so I have to dig directly into there. So it's not that long ago that Society Pass itself got listed. So you're already talking about the next spin-off listing?
I can't talk too much about it, but yes, that is the model. The model, of course, is acquiring the subsidiaries, building it up, spending a significant amount of management effort, of course, capital and time, and hopefully at the end result of which the entrepreneurs that sell to us, of course, then are rewarded for staying behind and growing their individual subsidiary within the larger ecosystem.
Thank you. So we've talked about how it should work, the great stories, the glory. Let's turn it a little bit around. Starting with JJ. So you're buying companies, you're putting all the effort into. How much are you on target? Say it worked out exactly like we wanted, or have you come to a point where like we should have better not? And what do you do if an acquisition so far hasn't worked out the way you wanted it?
Yeah, I think we see a typical portfolio kind of situation, right? So we have got about a dozen, just over a dozen brands now. I would say a third above expectations, a third within expectations, a third more work to be done, right? So quite typical of a portfolio kind of situation. What typically happens is that like within the portfolio, within the brand itself is where we do the sort of like, thinking around like what we do. So in any one brand, typically you have some products that are sort of reaching the sort of end of life of it. So time to sort of retire some of these products and then launching some new versions or new variations of the products in there. So that tends to be the effort that we do in a brand perspective to look into the product portfolio.
Kieran, so you said a lot of founders stay on board. How does it work when their baby gets a new daddy, kind of thing? And you have to tell them, we have to shut down these products off the portfolio you brought to the table and brought up.
So you're right in the sense that, especially for the brands which are sizable or have, let's say, more complicated operations, we do get the brand owners to stay with us for a few years at least, to ensure that the baby is taken well care of, and they're around to see that it's taken well care of. And so that's very important. Having said that, in most of the acquisitions that we've done, if they are simple enough, the integration process, which is the handover from the seller to us, that will typically take between 1 to 3 months. And then we are in full control of driving the brand's growth from that point onwards. However, in some of our largest acquisitions, we've had the founders stay on and continue to work with us as we integrate the business over a longer period of time and then help to grow the brand beyond where it is today. The way we manage this process is that there are a few areas that we really come in and be able to help the brands. In particular, around operations, I think that's a clear spike we have. We have a network of 3PL providers in this region where if you want to, like for example, if you want to expand to Hong Kong, we can spin a warehouse in Hong Kong within a few days and get your product to Hong Kong and sell in Hong Kong market within a few days. Same with Australia. We've already had one of our largest acquisitions is Marvable, which is Singapore's largest chair company. We've been able to expand their business to Australia and now generating about 25% revenue from Australia. So we do define these capabilities that we have a spike in and offer that as the business plan to the founders and then help to execute on this immediately after taking over. The founders, though, very strong, most of the cases in understanding their own product, understanding the consumers, and we work with them to align on saying, okay, what are the new products we want to bring to market in the next 6 months, and how can we start to work on that? So it's a very collaborative kind of a way in which we work with the founders.
Sorry, I don't let you get away with, everything is sunshine and flowers. So how do you deal? Obviously, they went out, wanted to get acquired, not just for the money because they hit a hurdle. You bought them because you saw a potential, but they haven't cashed in on that. So what happens when that conversation gets to the point, sorry, you hadn't it all figured out. That's what we have to do and might be painful.
No, so of course there's always ups and downs, but most important here is to define the business plan up front, get full buy-in from all sides saying, this is what we want to do with the brand together. And sometimes things don't work out in exactly as you planned and things go off track. In that case, you adjust and then that's how unfortunately life works in many cases. But that's and the incentives are in such a way that ups and downs, we still have the right incentives for the founders.
Dennis, your portfolio is a little bit more diverse than for Rainforest and Una. Two questions there. How do you make sure that you can really create economies of scale and synergies across those 6 verticals? It's a lot to swallow in a short period of time. Second, also following up on the question I posed to the other 2 gentlemen, have you had situations where it really didn't work out and said, yeah, we got something out of the deal, but overall, we're not continuing that direction?
So the synergies, first question. How we operate in a matrix management structure. So we have the C-suite, we have the country managers, and of course we have the business unit heads. And so with regards to synergies, every single business unit, if they're in one particular country, of course, we gut out the original back office. We centralize that back office to the country back office. And so whatever business unit is in that particular country, you would then recognize, of course, cost savings there. We also centralize the marketing budgets of all the business units. And so that's how we do we centralize the back office. For the front end, which is the revenue generating part, of course, that's a lot trickier because different brands have different business models, obviously. And so generally we allow them to continue with what the entrepreneurs are doing. We have a set of KPIs that, of course, they have to meet. And, of course, our KPIs are revenues, users, and merchants. And there's a set of KPIs that each of the business units have to meet. Getting to the second question, if they don't meet those KPIs, well, there's a long discussion. Of course, the discussion then becomes, we eventually wind it down in the extreme case. Of the 8 companies that we've acquired, 1 has been wound down, okay? And, that process took over, we acquired that company 2 years ago. And so, it's been 2 years. Obviously, it was a POS software company that we bought in Vietnam prior to the pandemic happening. And, you can't really operate a restaurant business where, in fact, the restaurants are closed. And so, the pandemic has very much affected that business, and we basically cut off the strings beginning of this year.
One thing you mentioned earlier, and I have to dig a little bit deeper, right? Profitability. So that business model that Una and Rainforest are building is buying profitable brands. So by default, you have cash coming into the company constantly. Your business model is different. So how do you make sure you have also an extended runway to eventually satisfy your shareholders that hopefully might want to see some return on their investment other than share price fluctuations?
We operate in e-commerce. E-commerce platforms by nature are unprofitable. I've yet to see an e-commerce platform anywhere in the world that is profitable. If you look at the 2 largest tech companies here in Southeast Asia, Sea and Grab, you will note that the road to profitability is a ways apart, a ways down the road. And so with regards, we'll take our lifestyle vertical. It's called La Flare, operates in Vietnam. It is also a lifestyle e-commerce platform. So we sell high branded, international premium branded clothes, women's products, so on and so forth, jewelry. It is unprofitable. I don't see La Flare, the e-commerce platform business, becoming profitable anytime soon, if ever. And so what are we doing differently? You asked the question earlier. Well, we are changing that business model. We're using the acquisitions focus model of Society Pass. We're imparting that into La Flare. La Flare now is transforming itself from just an e-commerce platform to acquiring brands. We're becoming a distributor of premium brands in Vietnam. We're acquiring logistics companies. I note, and we're creating and trying to capture the value of the entire value chain. I note that the first 80-90% of that retail chain is actually profitable. But when you think about it, it's actually the last mile e-commerce platform that's unprofitable. And so if you're focused on where the competition is, where the marketing spend is, where the consumer acquisition cost is, it's a no-win situation. And so LaFleur now is integrating the back parts of that value chain, that as it integrates, it becomes profitable.
Similar like what a Castlery did in owning the supply chain.
Absolutely.
You said there are no profitable e-commerce platforms. Wouldn't Amazon fall into that category? Sorry.
Well, Amazon, since it started back in the early 90s, has been profitable for what, 3 quarters? So I'm not going to talk about too much there, which there's no point talking about. But it does suggest that e-commerce platforms themselves, it's a very different deal. Now, e-commerce, Amazon today is a much different animal than when it started 20 years ago, right? And so if you say the e-commerce platform business, well, that's probably a much smaller percentage of revenues than what Amazon does. Its AWS, for example, business is extremely profitable. And so there's a lot of things that Amazon has taught a lot of us here in e-commerce throughout the years on what to do and what not to do.
And you could argue they're more of a logistics company in the e-commerce space than just a platform.
Absolutely.
Right? So we have 1.5 minutes roughly left. So I have to ask the question, you are all acquiring companies or brands. What's your end goal? What's your end game? Getting listed or just grow it until eternity and buy an island off Tahiti? JJ.
So we don't acquire to exit like how Society Pass looks at it. We acquire to sort of build a portfolio of brands. The end state is really 3-5 years out from now. It's a house of brands catered to sort of the modern parent. Everything from pregnancy all the way to sort of like a 12-year-old kid. You have a set of products across it, and we're able to realize synergies across these brands. And that's how we think about it. There's lots of traditional house of brands out there. They, again, win the physical shelf. We want to be a digital version of it for the parents. We focus on a digital shelf.
So how long is your vision on how far have you planned out your journey? Is it 5, 10, 20 years?
I mean, the vision statement is sort of 5, 10 years out. Like the business plan is shorter in nature.
What about you, Kieran? IPO on the card somewhere?
So exactly. So I think because we acquire profitable brands, I think that's the aim, is to become a profitable company and continue to grow the profits over time, to become a digital version of Unilever or P&G. I think that's the big vision that we have, and potential exits as a profitable company through IPO. I think that's the aim for me. I have already, this is my 3rd startup, no IPO yet. So this time will be an IPO.
It's time.
It's time for an IPO.
Thank you.
Society Pass is inspiring in that sense.
Thank you. Dennis, then the last words for you. So when would be, what's your end goal? Make it five listed entities, or there's no limit to the game as long as shareholders want you to play it?
Society Pass is building the next generation digital ecosystem in Southeast Asia. We do that through the acquisitions of market-leading startups, principally in the 6 verticals that we are operating in. We're about to launch our, we believe, paradigm-shifting loyalty platform onto the rest of our ecosystem. As we build that out, we intend to change the way consumers and merchants interact with one another here in Southeast Asia. And so watch out for our Society Points. It's coming out very soon with the acquisition of our Guerrilla Networks, Singapore-based telecoms company. We intend to gamify the entire retail experience. We're going to bring in some online shopping through our digital advertising vertical, Thoughtful Media. And so you're going to see a lot of very innovative technology coming out from Society Pass over the next 3, 6, 12 months.
We'll keep a close lookout. Thank you very much, Dennis, Kieran, and JJ.
Thanks.
Thanks a lot.
And thank you, Lars. Fantastic session. In our next session on Hit the Trifecta of Customer Experience with Netcore, we have with us Triton de Souza, Vice President of Southeast Asia Netcore Cloud. This session is powered by Netcore Cloud.